Hi there, it's Friday the 21st of February 2020. I'm Steve Towers. Welcome to ITB, coming to today from Tokyo. Let's get started. The next step in the Inclusive Frameworks digitalisation project will take place this weekend in Riyadh, where the G20 finance ministers will meet. The finance ministers will review the status of the project and possibly discuss the US proposal for Pillar 1 to be a safe harbour. In preparation for the meeting, the Secretary-General of the OECD has issued his regular tax report. The report summarises the expected revenue impact of the two pillars. On average, low and middle income economies would gain from Pillar 1, experiencing a higher rate of increase in revenues than high income economies, even though larger market jurisdictions will benefit more in absolute terms. Investment hubs, where the analysis suggests that levels of residual profit are high, would experience significant losses in tax base from Pillar 1. For Pillar 2, the analysis suggests that on average, all jurisdictions would experience increases in tax base and tax revenues, though these results depend significantly on Pillar 2 design and on the responses of MNEs and governments. Overall, the combined revenue gains from both pillars are broadly similar across high, middle, and low-income jurisdictions. For a copy of this OECD report, please go to our website or app. In Spain, the government has decided to proceed with its 3% digital services tax. A bill for the tax was approved by the government this week for introduction into Parliament. You'll remember that the previous bill for the tax lapsed when parliamentary elections were held in 2019. Meanwhile, in the Czech Republic, a government spokesman has confirmed that the government intends to continue with its plan to impose a 7% DST, despite pressure from the US government. The US has taken another step in the Airbus subsidies dispute. The US Trade Representative has announced that the US will increase the customs duty rate for aircraft imported from the EU from 10% to 15% effective the 18th of March 2020. For a copy of the USTR notice, please go to our website or app. The Australia-Peru Free Trade Agreement entered into force on the 11th of February. For a copy of the Australian Government announcement, please go to our website or app. The OECD has released a public consultation document called Model Rules for Reporting by Platform Operators with respect to sellers in the sharing and gig economy. Public comments are requested by the 20th of March. For a copy of the document, please go to our website or app. In Australia, the High Court has refused the taxpayer leave to appeal in Burton's case, which concerns the restriction on foreign tax credits for US tax paid on a capital gain. That means that the decision of the full federal court in August 2019 is the final word in the case. Also in Australia, the High Court has decided a case in regard to tariff classification for customs duty purposes. The issue was whether particular products were to be classified as medicaments and therefore duty-free, or alternatively as either sugar confectionery or other food preparations, in which case the duty rate would be 5% or 4%. This case is interesting because the court needed to interpret the International Convention on the Harmonised Commodity Description and Coding System, and the fact that the English and French versions of that convention appeared to be inconsistent. For a copy of this case, please go to our website or app. And finally, in Australia, the tax authorities have released the final version of guidance on the taxation of offshore drilling units in Australian waters, which was released in draft form in September 2019. The final guidance makes only minor changes to the draft version. For a copy of the final guidance, please go to our website or app. In India, the Gujarat High Court has decided a case in regard to the imposition of integrated GST on ocean freight services. The case concerns the transport of goods which are imported into India. A non-resident exporter sold goods on a CIF, cost, insurance and freight basis to an Indian importer. The non-resident exporter contracted with a non-resident freight company to transport the goods from the export country to the customs clearance station in India. Under two notifications issued in 2017, the freight service was treated as subject to Indian IGST, which was imposed on the Indian importer under the reverse charge mechanism. In other words, on the basis that the Indian importer was the recipient of the freight service. The court held that the IGST cannot be imposed on the Indian importer because the two notifications were invalid for two reasons. Firstly, they went beyond the provisions of the IGST Act, and secondly, they breached the Indian Constitution. A key aspect of the decision was that the Indian importer was not the recipient of the freight service. The recipient was the non-resident exporter. For a copy of this case, please go to our website or app. Also in India, the Surat Income Tax Appellate Tribunal has decided a transfer pricing case on the basis that an interest-free loan from an Indian parent company to its Singapore subsidiary should be treated as quasi-equity, and therefore no interest income should be imputed. An Indian parent company had formed a Singapore subsidiary as a special purpose vehicle to hold as a long-term investment a 46.2% shareholding in another Singapore company. The Singapore subsidiary had no other assets or operations. The Indian parent had funded the Singapore subsidiary with a mixture of common shares and redeemable preference shares. In order to redeem some of the preference shares, the Singapore subsidiary borrowed from a third-party bank in Mauritius, which was indirectly guaranteed by the Indian parent, and it also borrowed an interest-free loan from the Indian parent. The tribunal held that the loan from the Indian parent and the redemption of the preference shares were together a closely linked integrated transaction, and thus the loan was made in the capacity of shareholder, not creditor. It therefore concluded that the loan was quasi-equity and thus no interest should be imputed. For a copy of this case, please go to our website or app. In Indonesia, the government has announced that the long-awaited tax reform bill, now called the Omnibus Bill on Taxation, has been introduced into Parliament. According to the government's announcement, The bill covers many topics, including these major measures. Firstly, a reduction in the general corporate income tax rate, which is currently 25%, to 22% in 2021 and 2022, and then to 20% in 2023. Secondly, a reduction in the special corporate income tax rate applicable to certain publicly listed companies, which is currently 20%, to 19% in 2021 and 2022, and then to 17% in 2023. And thirdly, digital transactions conducted by sellers or overseas marketplaces will be taxed. The announcement does not indicate whether this tax will be VAT or a significant economic presence rule for corporate income tax, both of which have been mentioned by government ministers in the past. For a copy of the government's announcement, please go to our website or app. Also in Indonesia, Parliament has approved the government's plan to introduce a plastic excise tax to be imposed on plastic producers and importers. Indonesia's plastic waste is among the highest in the world. For a copy of a Ministry of Finance press release on this matter, please go to our website or app. Japan's increase in its standard consumption tax rate from 8% to 10% on the 1st of October 2019 caused the country to report GDP growth of negative 6.3% in Q4 of 2019. And that's not counting any slowdown in this current quarter due to COVID-19. In Singapore, the government has presented its 2020 budget in the context of a weakening economy due to COVID-19. The following tax changes caught my eye. The planned increase in the standard rate of GST from 7% to 9%, which was scheduled for 2021, has been deferred, but it will happen by 2025. And in regard to corporate income tax, accelerated tax depreciation over 2 years will be available. The carryback period for unclaimed tax depreciation and tax losses is increased from 1 year to 3 years, and a number of tax incentive programs which were scheduled to expire have been extended. For a copy of the government's summary of all its tax changes, please go to our website or app. In Denmark, the tax authorities have issued guidance in regard to the application of the tax loss limitation rules in an intra-group merger. For a copy of the guidance, please go to our website or app. Also in Denmark, the National Tax Tribunal has decided a case in regard to the blocked payment of royalties. A Danish parent company had a subsidiary in Venezuela. The subsidiary owed US dollar denominated royalties to the parent company. The royalties were accepted as satisfying the arm's length principle. However, the subsidiary was unable to obtain Venezuelan exchange control approval to pay the royalties. The Danish tax authorities agreed to defer tax on the royalties until they were paid. 3 years later, while the royalties were still unpaid due to lack of exchange control approval, the subsidiary paid a US dollar denominated dividend to the parent company. Apparently, the dividend payment was funded in a way which did not breach the exchange control rules. The Danish tax authorities treated the dividend receipt as a payment of the outstanding royalties, on the basis that in an arm's length situation, long overdue creditors would be paid before dividends are paid to shareholders. The tribunal rejected that claim. It held that the payment of royalties without exchange control approval was illegal in Venezuela, and thus it cannot be presumed that arm's-length parties would have paid the royalties before the payment of dividends. Also, the tribunal held that the dividend receipt could not be recharacterized as royalties, as the high standard for recharacterization under the OECD transfer pricing guidelines was not satisfied. For a copy of this case, please go to our website or app. In the EU, ECOFIN has made some changes to its lists of non-cooperative tax jurisdictions. Firstly, in regard to the blacklist, 4 jurisdictions, Cayman Islands, Palau, Panama and Seychelles, have been added to the list. As expected, Turkey was not added to the list but was given more time to comply. There are now 12 jurisdictions on the black list. And secondly, in regard to the grey list, 16 jurisdictions have been removed on the basis of having implemented their commitments. Before the ECOFIN meeting this week, Poland's finance minister stated that low-tax EU member states should be included in the 2 lists. That idea was not adopted by ECOFIN. For a copy of ECOFIN's press release on the 2 lists, please go to our website or app. Also in the EU, there have been a number of developments concerning VAT. The first development is that ECOFIN has formally adopted 2 sets of rules on which there was political agreement in November 2019. The first is the collection, storage and exchange of VAT payment data from payment service providers. And the second is a simplified VAT regime for small businesses. For ECOFIN's 2 press releases on these matters, please go to our website or app. The second development is that the European Commission has published a regulation in regard to the new e-commerce VAT rules, which will commence on the 1st of January 2021. The regulation sets out the content of the VAT returns for the suppliers and intermediaries, which will be subject to the new rules. For a copy of the new regulation, please go to our website or app. And the European Commission has published a report which assesses the invoicing rules in the EU VAT directive. For a copy of the report, please go to our website or app. And 2 other developments from the European Commission. Firstly, the Commission has published its proposal for a codification in regard to the EU directive on administrative cooperation in tax matters. And secondly, the Commission has published its report on the EU's special tariff preferences for customs duty purposes. For a copy of the 2 documents, please go to our website or app. In Spain, the tax authorities have issued guidance on whether foreign entities should be treated for Spanish tax purposes as taxable entities or as tax transparent. According to the guidance, the foreign tax treatment of the foreign entity is determinative. Thus, if the income derived by the foreign entity is not taxed at the level of the entity, is taxed at the level of the members of the entity, and the income maintains its character in the hands of those members for the purposes of the foreign tax law, then the foreign entity will be treated as tax transparent for Spanish tax purposes. In South Africa, commentators have suggested that the Inclusive Frameworks guidance on the transfer pricing of financial transactions, which was released last week, is likely to allow the South African tax authorities to impose thin capitalisation limits, despite, or maybe because of, the absence of any specific guidance on that topic by the tax authorities. You'll remember that Bahrain has recently issued guidance on its economic substance requirements. I've now obtained an English language version of the guidance. For your copy, please go to our website or app. In Qatar, the tax authorities have issued 6 items of guidance on the MAP procedure under double tax treaties. For a copy of the guidance, please go to our website or app. In Canada, British Columbia has announced that it will impose provincial sales tax on non-resident providers of electronic or digital services, effective the 1st of July 2020. This will be the 3rd Canadian province to do so. In Chile, the tax authorities have issued guidance on the triggering of a most favoured nation clause in regard to the interest and royalties articles in the Chile-Italy Treaty. The MFN clause was triggered by lower rates in the Chile-Japan Treaty, which is effective from the 1st of January 2017. For a copy of the guidance, please go to our website or app. In Colombia, the tax authorities have issued an executive order in regard to the country's GAR. GAR applies to transactions which have one or more artificial steps with no apparent commercial or economic purpose and with the aim of obtaining a tax advantage. If GAR applies, the tax authorities are permitted to recharacterise the transaction. If a double tax treaty is relevant, the treaty applies to the transaction as recharacterised. In Peru, the tax authorities have issued guidance which contains a so-called catalogue of aggressive tax planning schemes, which are likely to trigger the country's GAR. For a copy of the guidance, please go to our website or app. In the US, it seems that everyone is talking about technical corrections. Firstly, Treasury and the IRS have published technical corrections to 2 recently issued final regulations. The final regs on transfers of appreciated property to partnerships with related foreign partners, and the final regs on the BEAT tax. For a copy of the technical correction documents, please go to our website or app. And secondly, the Congressional Research Service has issued a short report on possible technical corrections to the 2017 US tax reform legislation. For a copy of this report, please go to our website or app. Also in the US, a new major transfer pricing case started this week. It concerns the value of intangibles which were transferred by Facebook US to its Irish subsidiary in 2010. Commentators have said that the potential US tax liability at stake could be as high as $9 billion. And finally, in the US, a member of the public has sent a detailed technical memorandum to the IRS, which argues that a Hong Kong company, which was involved in a recently reported Hong Kong profits tax case, might have an unrecognised US tax liability. For a copy of the memorandum, please go to our website or app. And we've had only one treaty development this week. It's been announced that the Ireland-Netherlands Treaty will enter into force on the 29th of February. I have two articles for you this week. The first is a report called Proposed Framework for Foreign Comparables Selection and Adjustment. It's written by Sebastian Gonnet, Bert Steens, Christoph Buslink and Matthias Petuchnik, and it's published accompanied by an empirical paper by the Transfer Pricing Economists for Development Group. For a copy of the report and the empirical paper, please go to our website or app. The report is written for transfer pricing specialists, particularly economists. The report's abstract says this: our findings infer from economic modelling and empirical evidence that, in the absence of reliable domestic comparable companies, foreign comparables should not be rejected a priori, and that there are merits to using foreign comparables from countries with a similar risk profile. Selecting comparables that are operating in countries geographically close to the country of incorporation of the tested party, even though appealing and widely used in practice, seems to be less helpful. Our results also suggest that using comparables from countries with a different, typically lower risk profile necessitates country risk adjustments. An interesting consequence of our study is the suggestion that simplification in transfer pricing, for instance, fixed returns for certain baseline activities, as recently suggested by the OECD, is not out of reach, and that large data sets of comparables may well provide insightful proxies for an economically sound estimation. If such simplified measures are adopted at international levels, the inherent risks of operating in the developing countries will need to be accounted for, with, for instance, higher than average baseline profits in these countries. The second article is called The Troubled Story of the Hungarian Advertisement Tax: How Not to Design a Progressive Turnover Tax. It's written by Rita Sadowski and Balas Karolyi, and it's published in Kluwer's Intertax Journal. The Hungarian advertisement tax was introduced in 2014, but is currently effectively suspended. During its years of operation, it stirred up a number of disputes, ranging from European Commission challenges based on state aid and EU fundamental freedoms, to a dispute with Facebook concerning the non-discrimination article of the Hungary-Ireland double tax treaty. Two features of the tax explain these challenges and disputes. Firstly, the tax was structured as a progressive turnover tax. In other words, it was levied on the turnover of relevant taxpayers, but at an increasing rate as the turnover increased. According to the Commission, this structure was intended to target the tax on non-resident taxpayers. And secondly, the penalty provisions for failure to register for the tax on a timely basis were severe. For being 1 day late, the penalty was €31,500. If the taxpayer was 5 days late, the maximum penalty of €3.15 million applies. This article discusses and critiques all of these challenges and disputes, with one eye on the digital services taxes which some EU member states have introduced. The authors write this: the troubled story of the Hungarian advertisement tax is an accurate demonstration of all of the legal issues that can arise with respect to turnover taxes levied at progressive or graduated rates that are being introduced with increasing frequency, with the more or less hidden purpose of shifting more fiscal burden on financially strong multinational enterprises while shielding smaller domestic players from such extra burden. As the analysis shows, such taxes are mainly problematic under EU law. However, depending on their detailed rules, their compatibility with various non-discrimination provisions under domestic constitutional law, tax treaties, or even WTO rules may also be questionable. Well, that's the way it is this Friday, the 21st of February 2020. I'm Steve Towers in Tokyo. Have a great weekend.